Hello friends, welcome to Madhuram Investment. Myself Ramesh Sahu, and in today's session we are going to talk about a very important topic in our stock market, that is beta. A lot of people talk about beta like high beta stock, low beta stock, and while making a selection of a stock for a intraday or maybe for a long-term investment, beta plays a very good role. So in this session we will see why beta is needed in stock market, what is beta, formula to calculate beta, and then we'll see what is mean by high beta stock and what is mean by low beta stock with examples. So let's get started. So the first question is why beta is needed. For that, we need to understand the risk associated in stock market. So for any organization, there are two types of risk: systematic risk and asystematic risk. So systematic risk are the risk which a company cannot or organization cannot manage. These are the risk like simply like recession, war, interest rates changes, or political uphill, like as we can see currently happening in Russia and Ukraine, or those kind of thing which organization or company cannot handle. These are the unavoidable circumstances which control over the events, like as we have seen COVID, right? So on COVID cannot be controlled by anyone. It was unpredictable. So and on that time we have seen a huge correction in the market. They cannot be eliminated by diversification. Yeah, as we know, right? If what level of diversification you had in your portfolio or in your organization, but no, none of the portfolio organization was saved from the effect impact of the pandemic, right? COVID pandemic. So these are systematic risk. Systematic risk has a vast magnitude of impact affecting the overall market. Yes, either you talk about recession, war, or pandemic, or interest rate change, this is impacting the entire market, right? All the companies present in the market, right? So this are the situation which cannot be controlled by a company. So only one way that we have with the help of which we can handle the systematic risk is hedging or asset allocation. Like what you can do is whatever uh, like open positions you have in the market, what you can do is you can hedge those against some safe asset class. So that is how you can, at least you can try to handle the systematic risk. On the other side, unsystematic risk are the risk which can be managed by a company. These risks are simply like operational risk, or the business risk, or in business insolvency, or you're not able to handle your debt properly. So those can be managed by very well. This can be eliminated by diversifying. Like if you have different diversified product portfolio or the investment portfolio, this helps you to minimize your unsystematic risk. This systematic risk can be like extent, or the impact of this risk is restricted within a company or the industry or a sector, right? It is not like the entire market is impacted by that. Maybe a sector going through some kind of regulatory change or the environmental change, or maybe a company is going through some kind of management change. So those, because of those changes, there is a risk in the company which may impact your stock price. On the other side, diversification is one of the best way with the help of which we can manage this unsystematic risk. So these are the risk we have in the stock market. So in which beta will tell you which company has how much risk. So let's see how beta will help us in this. So for that, let's understand what is beta first. So beta is a way of measuring the stock market's volatility compared with the overall market's volatility. So as we know, market is very volatile. Market may go up or down in any direction. So in with the help of beta, we'll see when market is giving you a return of 1%, how much your stock is giving you. So it is basically like, let's say, one span of time, let's say in 1 year or 6 months, if the market is giving you 10% return, then how much your stock is giving. If your stock is giving same as market, that means your beta is same as the market return. So that is how the beta is calculated. So let's understand this within formula. So how the formula says is the beta is calculated as the covariance of your return of your individual stock divided by the return of your stock market over the variance over the period of time. Let's say when we calculate a beta, so we should consider a return of a stock of minimum 1 year or maybe 1 to 3 years. So in that way we'll see day by day how much your market is giving return, and on it how much your stock is giving you return with the help of this formula. So in that way you'll be able to calculate a beta properly. Let's understand this more in detail. There are different scenarios in beta. So when you see a beta greater than 1, that means your stock and the market is moving in the same direction, but your stock is giving you more return. Example, like let's say if in 1 years of time your market is giving you 10% return, in that case the stock will give you more than 10% return. And if the market is giving you minus 10% of return, then in that case your stock may fall more than 10%. So this is how the when the beta is greater than 1. Second example is when your beta is equals to 1. That means your market and the stock is moving in the same direction with the same momentum. So if your market is giving you 10% return, then stock will also give you 10% return, vice versa. Third example is when you see your beta is greater than 0 but less than 1. That means your stock is moving in the same direction as the market is moving, but the stock will give you less return. That means if your in 1 year's a time your your market is giving you 10% return, then your stock may not give you 10% return, it will give you less return. The fourth example is when you see beta is equals to 0. In this case your stock and the market is not correlated. That means if market is giving you positive return, your stock may give you a positive negative return. There is no correlation with the market. Last but not the least, when you see beta is less than 0, that means your stock is moving opposite direction of the market. That means if your market is giving you positive return, in that case your stock will give you negative return and vice versa. So these are the different scenarios that we have, and when we see different beta of a stock. So this is how you should consider this stock. This will help you very well when you see, like if let's say market is at the top, then in that case you have to buy a stock which is having a beta is less than 0. That means if market will fall, it will give you a positive return. On the other side, when market is at the bottom, that means you see a lot of stocks are cheap. So that in that case you should buy a stock which has a beta greater than 1. That means whenever market will give you will perform good, on that time your stock will perform better than the market. So now see what is high beta stocks. High beta stocks are positively correlated with the index, and their amplified magnitude is higher uh, than the index. So what does it mean? It means when we are in a bull market, in that on that time these high beta stocks will outperform the market. But on the contra side, when we are in the bear market, on that time these stocks will fall more than the market. So these stocks are good when you are in a bull market, but on the contra side, when you're in bear market, this type of stocks may give you more negative returns. So when the beta of a stock is greater than 1 is called as high beta stocks. So now let's see what is low beta stocks. Low beta stocks are also positively correlated with the return of the index, but it is magnitude is similar to the index or maybe less than that. So what does it mean? It means when the index or the market falls or the goes up, in on that time these stocks will fall as much as the market is falling, or may go up as much as market is falling, and maybe less than that. So this type of stocks are good when you're in bear market, or when you want when you're not ready to take more risk. So on that time you should go for the low beta stocks. When beta of a stock is greater than 0 and less than 1, those stocks are considered as low beta stocks. Now let's understand this with the chart. So as here you can see, this is the market, how market is performing. So here you can see when market falls half point, on that time the high beta stocks are falling almost like 1.5 points, and low beta stocks are also falling like almost like a half point only. And when the market corrects for the almost like a 1 point, on that time you see the high beta stocks also uh, performing better than that. So this is how the high beta stock and low beta stocks are perform in the bull and the bear market. Basically when you form your portfolio, you should have combination of high beta stocks and low beta stocks, so that it will give you a good balance to your portfolio. So this is how you should select your portfolio. That's all for the day. Thanks for watching. And if you have any queries, please put it in the comment box. I would like to reply your queries. And if you haven't subscribed to my channel, please subscribe to this channel. Thank you and have a good day.